Welcome to the deep dive. Today, we're going deep, deep into a question we got from Peter Y.
Okay.
He's curious about Subchapter K
Right.
of the Internal Revenue Code,
Yeah.
which, as you know, governs partnerships for tax purposes.
Intricate is putting it mildly. It's one of the most complex areas
Oh, absolutely.
in the tax code.
Without a doubt.
The source material even calls it a magnet for schemers, devising and implementing abusive tax transactions.
Well, Peter, we're here to help you navigate this tricky territory.
Yeah.
So to start, I gotta say, the word partnership is thrown around pretty loosely these days, Business partners, romantic partners.
Yeah.
Heck, I've even heard of parking partners in San Francisco.
Oh, wow.
But when it comes to taxes, the definition gets a lot more
Absolutely. The way that definition has evolved over time is fascinating.
Yeah.
Our source material compares it to the evolution of art movements. Early on, the tax code's approach to partnerships was very cubist.
Okay, so like those early cubist paintings where you can barely tell what you're looking at?
Exactly.
Yeah.
But just like art, the understanding of partnerships has become more fluid over time.
Right.
You could say it's shifted toward something more like Impressionism.
Okay.
In 1999, we saw a major change with the check-the-box regulation.
Oh, yeah, the check-the-box regulations.
Instead of asking, what is a partnership?
Yeah.
We started asking, what is an entity?
Did that make things simpler?
It was intended to, but it didn't quite work out that way.
Oh, really?
The regulations introduced this very broad term, organization for federal tax purposes, which can encompass almost any agreement between two parties.
Right.
If the organization is recognized as separate from its owners, it can get pulled into what our source material calls the Subchapter K abyss.
An abyss, huh? Sounds a little daunting. So even though we have these check-the-box regulations, all that pre-1999 case law about defining partnerships is still relevant.
Unfortunately, yes.
Oh.
Court decisions like Superior Trading LLC have reaffirmed that those older precedents still hold weight, even with a more modern approach.
Right.
Those early interpretations continue to cast a long shadow.
Okay, so before we get lost in the abyss, let's try to break this down a little bit.
Yeah.
Our source material introduces a really helpful analogy, I think, of a clubhouse to represent arrangements that fall under Subchapter K.
Yeah.
Can you walk us through that?
Certainly. Imagine a clubhouse with two main sections.
Okay.
One is labeled shared expenses, and the other, much larger section, is profit.
Okay.
Now, the shared expenses area is fairly straightforward.
Yeah.
Think of something like two property owners who jointly construct a drainage ditch. Those kinds of arrangements aren't usually subject to Subchapter K.
Okay.
But once you step into the profit section, things get a lot more interesting and a lot more complex.
That's where the real action is.
Yeah.
But even before you can enjoy the profit section of the clubhouse, there's a bit of a screening process, right?
Exactly.
Our source material mentions an intent seller.
Yes.
Where the IRS determines if an arrangement genuinely has a profit motive.
That profit motive is absolutely key in determining partnership status.
Okay.
The IRS wants to see that the arrangement is driven by legitimate business goals, not just a desire to minimize taxes.
So you're saying even before you get to the intent seller, you have to pass what the source material calls the sham transaction threshold.
That's right.
Yeah.
To be treated as a partnership, an arrangement needs a solid business purpose beyond just tax benefits. This is where the IRS separates those engaging in legitimate tax planning from those our source material calls schemers.
And it sounds like the IRS takes this distinction very seriously.
They do.
Yeah.
And to make things even more interesting, that business purpose doctrine operates in a bit of a gray area.
Okay.
The line between clever tax structuring and a sham transaction can be pretty blurry.
So how does the IRS determine what's a legitimate business purpose versus a sham?
Well, they have a few tools at their disposal. One is a set of criteria known as the Luna factors, which we'll delve into later. They also have anti-abuse rules, spelled out in Treasury Regulations Section 1.701-2, which sets a stricter standard for arrangements where the main goal seems to be tax reduction.
Got it.
But even these rules have faced pushback.
Really?
Some courts, like in the historic Boardwalk Hall case, have actually rejected their application.
So even the IRS's attempts to clarify things have created more controversy. Subchapter K really is starting to sound like a minefield.
It can be.
Yeah.
And to help you understand why,
okay,
we need to examine some real-world examples.
All right.
Case studies are essential for grasping the nuances of Subchapter K.
Right.
And thankfully, our source material provides several.
Okay, great.
Let's start with the Madison Gas and Electric case,
Right.
where a utility company teamed up with others to produce electricity.
So how did that play out in terms of partnership classification?
Well, the profits from this joint venture were distributed in kind, meaning as electricity.
Interesting.
Rather than as cold, hard cash.
So you might think that would make it fall outside the realm of a partnership.
You might think that.
Yeah.
But the court disagreed.
Oh, really?
They ruled that it was a partnership because it involved something more than a mere expense-sharing arrangement. The intent to generate profit, even in a non-traditional form, was clear.
So even when you're not dealing with dollars and cents, the profit motive can still be front and center.
Precisely.
Okay.
And that profit motive needs to be genuine.
Right.
Let's contrast Madison Gas and Electric with another case.
Okay.
ASA Investorings Partnership.
Okay.
This one involved a complex arrangement with a foreign bank that was specifically designed to exploit a loophole in the tax code.
Sounds like they were trying to pull a fast one.
You could say that.
Yeah.
On paper, everything looked like a legitimate partnership, meticulously structured to meet the technical requirements. But when the IRS scrutinized it, they found that its sole purpose was to generate tax benefits.
Got it.
It lacked any real economic substance.
Yeah.
So the court ultimately deemed it a sham.
It's a good reminder that you can't just play a shell game with the IRS.
Right.
They were looking for real substance behind those transactions.
Exactly right.
Okay.
And sometimes, even if you unintentionally create a partnership-like arrangement, you might be held to that classification.
Okay.
This brings us to the concept of estoppel.
Okay, before we get into that, I just want to remind our listeners that this program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple.
Absolutely.
iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
Sounds great.
We encourage you to submit your own questions for future deep dives.
Yeah.
Because there's always more to explore in the world of tax law.
Now back to estoppel.
Okay.
A case that perfectly illustrates this concept is Miletus. A taxpayer attempted to disavow a partnership he'd formed with his sons after their relationship went sour.
Oh, wow.
He argued that he never intended to create a true partnership.
Okay.
However, because he had already filed partnership tax returns, the court held him to that initial classification.
So even if you didn't set out to create a partnership, your actions can inadvertently land you in the clubhouse.
It highlights the importance of careful planning from the outset.
Right.
And that planning should involve getting expert advice, understanding the ins and outs of Subchapter K, especially before you enter into any kind of agreement that could be construed as a partnership.
Yeah.
Can save you a lot of trouble down the line.
That's great advice, and it leads perfectly into our next topic.
Yeah.
I understand there's actually a way to elect out.
That's right.
Of Subchapter K treatment.
Yes.
Under certain circumstances.
That's correct.
Is that right?
That's right.
Okay.
Code Section 761A
okay.
provides a sort of revolving door for certain types of arrangements, allowing them to avoid full or partial partnership treatment. It applies to two main categories, investment partnerships and operating agreements.
Okay, so tell me more about those categories.
Yeah.
How do they differ, and why would someone choose to elect out of Subchapter K?
Well, investment partnerships are all about passive investments.
Okay.
Where there's no active involvement in running a business.
Right.
Think of a group of friends pooling their money to buy stocks or bonds.
Okay.
Operating agreements, on the other hand, involve the joint production or extraction of property, but not the selling of those products or services.
Right.
A classic example is a group of oil companies that jointly own a well.
So one is passive and the other is active. But what are the implications of choosing to elect out? What are the potential benefits and drawbacks?
That's a great question and one we'll need to explore in more detail.
Okay.
But before we do, I think it's time to take a quick break.
Right.
To hear a word from our sponsor, iFindTaxPro, where tax and legal compliance are made clear and management of client communication simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
We'll be right back with more insights into the fascinating world of Subchapter K.
Okay. Welcome back to the deep dive. Before the break, we were talking about electing out of Subchapter K treatment under Code Section 761A.
Yeah.
It's important to note that this election isn't an all-or-nothing proposition. You can elect out of certain sections of Subchapter K while remaining subject to others.
So you could partially escape the clubhouse, so to speak.
That's a good way to put it.
Yeah.
For example, even after electing out, an entity might still be bound by partnership rules for purposes of investment tax credits.
Oh, wow.
It can get pretty granular.
Sounds like a tax lawyer's dream or nightmare, depending on how you look at it.
It certainly keeps things interesting. But here's where things get really fascinating. When you sell an interest in a partnership that has elected out of Subchapter K, it's treated as selling the underlying assets themselves, not the partnership interest.
Interesting.
This can have significant benefits.
Oh, really?
When it comes to capital gains and like-kind exchanges.
So there are some potential tax advantages.
Absolutely.
To be gained by strategically using this election.
Absolutely. But before you get too excited, remember that the requirements for qualifying for this election are quite specific.
Got it.
And this is where careful planning and consultation with a tax professional become absolutely essential.
So if you're thinking about going through that 761A revolving door, it's best to have a seasoned guide to show you the way.
Precisely. Now, if you do meet the requirements for the election, you might want to seek further assurance from the IRS. That's where Revenue Procedure 2002 OT22 comes into play. It allows taxpayers to request an advance ruling on whether their specific co-ownership arrangement qualifies for the 761A election.
So it's like getting pre-approval from the IRS?
You could say that.
A sort of blessing for your arrangement?
But be warned, the requirements for obtaining a ruling under this procedure are very strict. It's limited to tenancies in common. You can't have more than 35 co-owners.
Wow.
And there are tight restrictions on the types of business activities that qualify.
It sounds like they're trying to weed out the folks who are just trying to game the system.
The IRS wants to ensure that the arrangements seeking this exemption genuinely meet the criteria. But here's the good news. Even if your arrangement doesn't meet every single requirement for a ruling, it might still be eligible for the 761A election. You just won't have that pre-approved ruling to fall back on.
So we've covered the 761A election and the possibility of getting an advance ruling from the IRS. But let's not forget about those Luna factors we mentioned earlier. What role do they play in all of this?
The Luna factors are absolutely critical in determining whether an arrangement meets the definition of a partnership for tax purposes. They help the IRS assess the true nature of the relationship between the parties involved. Remember our clubhouse analogy? Well, you could think of the Luna factors as the wine tasting menu down in the intent cellar.
So they're like a checklist for partnership intent.
That's a helpful way to think about it. The Luna factors were established in an 1964 court case, and they've been a cornerstone of partnership determination ever since. They look at things like the agreement between the parties, the contributions each party made, their control over income and capital, how profits and losses are shared, whether business is conducted in their joint names, whether they filed partnership tax returns, whether they maintain separate books and records, and whether they exercise mutual control and responsibility for the enterprise.
Wow, that's quite a list. It really does feel like the IRS is scrutinizing every aspect of the relationship.
Thoroughness is their middle name. And while no single factor is decisive, the IRS will weigh all of them together to get a complete picture of the arrangement.
I can see how that would be helpful in those gray areas.
Exactly.
Where it's not immediately obvious what kind of relationship exists.
The Luna factors provide a framework for analyzing intent.
Right.
Which, as we've discussed, is at the heart of partnership determination.
So let's talk about how these Luna factors have been applied in real-world cases. We touched on the DJB Holding Corporation case earlier.
Right. The one where they tried to use personal guarantees as contributions to the partnership.
Exactly. Can you explain how the Luna factors were used to analyze that arrangement?
Well, the court meticulously dissected the arrangement using the Luna factors and ultimately concluded that it wasn't a genuine partnership.
Right.
For example, they pointed out that the agreement between the parties wasn't consistently followed. The profit allocation was changed arbitrarily without any clear business justification.
So even though they had a written agreement, their actions didn't match up with it.
Precisely, substance over form.
Right.
The court also determined that the alleged contributions made by the partnership, those personal guarantees, weren't truly valuable.
Oh, really?
The individuals were already obligated to guarantee the company's projects as employees, so they weren't actually bringing anything new to the table.
So the court saw through that attempt to create a partnership solely for tax benefits.
They did, and they also found that the partnership didn't exercise the level of independent decision-making you'd expect in a genuine partnership. It was clear that the corporation was calling the shots.
It sounds like they were trying to have their cake and eat it too.
Exactly.
Claiming partnership benefits without actually operating as true partners.
Exactly. And the DJB Holding case is a cautionary tale for anyone considering structuring an arrangement as a partnership. It's not enough to simply draft an agreement. Your actions and the overall substance of the relationship must align with the intent to form a true partnership.
So let's contrast that with the Madison Gas and Electric case.
That's right.
Where the court did find a legitimate partnership.
Yes.
Even though profits were distributed as electricity rather than cash.
And Madison Gas and Electric demonstrates the importance of thorough documentation. The parties in that case had a very detailed agreement outlining their partnership intentions. They also kept meticulous records, filed partnership tax returns, and demonstrated mutual control and responsibility for operating the power plant.
So unlike DJD Holding, they did everything by the book.
Essentially, yes, and that's in persuading the court to uphold their partnership status.
It seems like having a well-drafted agreement and good record keeping can make a world of difference when it comes to Subchapter K.
Absolutely. These cases show how the Luna factors can be used to both support and challenge partnership claims. It all depends on the specific facts and circumstances of each situation.
It's clear that Subchapter K is a very complex area of the tax code. But I think we've made some good progress in unpacking it today.
We have, and I hope our discussion has helped shed some light on the key considerations for anyone dealing with partnerships and the potential pitfalls to avoid.
Before we wrap things up, I just want to remind our listeners about iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple.
Great.
iFindTaxPro.com is a platform for professionals and their clients.
Awesome.
Open to everyone.
And remember, if you have your own tax mysteries you'd like us to solve, send them our way.
Definitely.
We're always on the lookout for our next deep dive.
Stay tuned for Part 3, where we'll offer some final takeaways and explore additional strategies for navigating the complexities of Subchapter K. Welcome back to the deep dive. We spent this episode, I think, spelunking through the caverns of Subchapter K, exploring its twists and turns.
It's been a journey.
And I hope you're feeling a bit more oriented in this complex landscape.
We've covered a lot of ground, from the historical evolution of partnership definitions to the nuances of the 761A election and the ever-important Luna factors.
But before we emerge from this fascinating world of partnership tax law, let's distill some key takeaways.
Excellent idea.
For Peter Y. And anyone else out there contemplating a venture into the clubhouse of Subchapter K.
Above all, remember that intent is paramount. The IRS wants to understand what the parties truly aim to achieve
Yeah.
with their arrangement?
Right.
Was it a genuine partnership with a shared purpose and a commitment to sharing both profits and losses?
Yeah.
Or was it something else masquerading as a partnership?
Right, like that wolf in sheep's clothing.
Exactly.
Trying to slip past the sham transaction threshold we talked about earlier.
And as we've seen, the IRS has a whole toolbox to unmask those disguised arrangements, from comparing them to other common business relationships to applying those trusty Luna factors.
Exactly. Speaking of the Luna factors, those 8 criteria provide a really powerful framework.
They do.
For analyzing intent.
They cover everything.
Yeah.
From the initial agreement to the parties' contributions, their control over income and capital, and even whether they filed partnership tax returns.
It's like a multifaceted test to ensure the partnership duck is actually quacking, wouldn't you say?
A very apt analogy.
Yeah.
And as we saw in the DJB Holding and Madison Gas and Electric cases, seemingly minor details can make a big difference in how those factors are applied.
Yeah.
A poorly drafted agreement, inconsistent actions, or a lack of proper documentation can quickly unravel even the most carefully structured partnership.
It really underscores the point that substance matters.
Absolutely.
Just as much as form in the eyes of the IRS.
Now, if you find yourself wrestling with a Subchapter K dilemma, recall that escape hatch we discussed, the 761A election. This provision offers certain arrangements, like investment partnerships and operating agreements, the option to opt out of full or partial partnership treatment.
But, as we learned, even that escape route has its own set of rules and limitations.
True, but it can be a valuable tool for arrangements that genuinely fall outside the traditional definition of a partnership. And even if you don't meet every single requirement for an advance ruling from the IRS, the 761 election might still be a viable option. It's definitely worth discussing with a qualified tax advisor.
Speaking of expert advice, it's worth reminding our listeners about iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple.
Absolutely.
iFindTaxPro.com is a platform for professionals and their clients, open to everyone.
Navigating the intricacies of Subchapter K is rarely a do-it-yourself endeavor. Having a knowledgeable tax professional on your side can save you a lot of headaches and potentially even some tax dollars.
Couldn't agree more so, Peter. Why? And all our curious listeners, as you venture into the world of partnerships and Subchapter K, keep these key takeaways in mind.
Intent is paramount. Document everything. Be consistent in your actions. And when in doubt, seek expert advice.
And one final thought to ponder, Peter. Our source material doesn't explicitly address this, but it's something worth considering. Given the complexity of these rules, what strategies can taxpayers and their advisors employ to ensure they're making informed decisions about partnership formation and Subchapter K treatment, aside from seeking those advance rulings from the IRS?
It's a great question to contemplate. There's always more to learn, more to explore in the world of tax law.
And remember, listeners, if you have your own tax puzzles you'd like us to unravel, send them our way. We're always eager for another deep dive.
Until next time, stay curious, stay informed, and may your Subchapter K adventures be as smooth as possible.
This program is brought to you by iFindTaxPro, where tax and legal compliance are made clear and management of client communication is simple. iFindTaxPro.com is a platform for professionals and their clients, open to everyone.